Whether you're a crypto newbie, an established investor, or operating a business in Web3, tax season can be an absolute headache, but it doesn't have to be a nightmare. That's where Crypto Tax Calculator comes in, the software platform founded in 2018 by brothers Shane and Tim Burnett, crypto fanatics who were fed up with the complexity of doing their taxes. As Coinbase's official global tax partner, CTC focuses on simplifying complex transactions, supporting over 300,000 currencies across Ethereum, Arbitrum, Optimism, as well as 1,000 other integrations. Sign up at realvision.com/CTC and get an exclusive 30% discount with the code RV30 at checkout. Is the most hated sector finally getting some love? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Jesse Felder, founder of Felder Investment Research. Hey, Jesse, welcome back.
Hey, Maggie, how you doing?
I'm okay. It's great to see you. So we just finished the U.S. session for stocks, and we saw them continue to rebound. Actually, it's a Russell that had the biggest gains, up 2%. The others were modest, sort of hanging in there at the close. We saw bond yields, meanwhile, edge a little bit lower as investors there focused on a weaker than expected retail sales report. And I feel like we're kind of stuck in this pattern, Jesse, where we keep getting conflicting signals, or at least off the surface, it seems to be conflicting. Weaker than expected retail sales, but then we get some pretty good earnings. So what's your sense of what's going on with the U.S. economy?
Well, I think we are getting conflicting signals. That's exactly what we're seeing, and I think that what we have to talk about what's priced into the markets versus what is likely to happen. And I think right now, we've heard so much talk about a soft landing for months, the last couple of quarters. I really think we've gotten to the point where we've priced in a no landing for the economy, where the inflation's going to come back down to the Fed's target, and the economy is just going to keep powering along. And that looks to me that's kind of what's priced into markets. Now, when the data starts to contradict that narrative is when we start seeing some interesting things play out in the market. So if it starts to look like, we get a retail sales number that maybe hints that, maybe a hard landing isn't off the table, or you get the CPI report that suggests, well, maybe inflation isn't coming back down to the Fed's target, it starts to do damage to that soft landing or no landing narrative. And the markets are going to have to start reacting to that. And I think that that's a trend that is going to continue or even grow over the next several months or a couple quarters. Is we're going to continue to get data that contradicts that narrative, that maybe inflation stays a little hotter than expected and growth comes in a little bit weaker than expected.
Which is not a good combo, right? If growth is going to be weaker than expected, you would hope to see inflation moving in the same direction so that the Fed can cut rates. That's what sparked everything in November. But you're right. It seems like they're both moving in an undesirable direction. Let's talk about inflation for a second. We really thought that was buttoned up, that it was moving in to a disinflationary situation. It was looking really well behaved. What's going on with inflation? What do you see happening? Is this a temporary sort of punch higher in some areas, or is this something more worrying?
I think, John Authors wrote an interesting piece this week for Bloomberg where he pointed out that, when inflation really started to take off, the worry was that goods inflation was going to force employees to ask for wage increases in order to meet the growing cost of living. And those wage increases were going to create some type of a positive feedback loop, which would, support demand and then support goods prices. And you get this wage price spiral. And the latest CPI report suggests that could be exactly what we're seeing right now, which is that if you look at that super core inflation, which is essentially the Fed points at as being representative of those wage, forces underlying inflation, it's suggesting that there's a huge jump there. And so I'm interested to see, do people start worrying again about this wage price spiral? Because it looks like that's still a major risk. And I think, you have to pay attention to what are the longer term drivers of that too. It's not just, I think so many people are focused on the pandemic and the supply chain shortages and things, But I think when you look at things like deglobalization and the stress that that puts on the labor force here in the United States, that's an important dynamic. And pair that with demographics, right? We've seen the baby boom generation really start to retire in waves, and especially when the stock market does well, they say, great, my retirement account is through the roof. I can now afford to retire. And so you have a shrinking workforce relative to the overall size of the population. At the same time, you're trying to reshore all this production. That is a really important inflationary force supportive of wages and a really hot labor market. So I think those longer term dynamics are kind of not going away, right? They've only gotten more significant. And there's not just kind of cyclical forces at work. There are those longer term dynamics that I think are important to keep an eye on as well.
Yeah, it's so important to talk about that backdrop, some of these big issues underneath. It's I think what's confusing for people, and I think about this all the time, is we sort of understand that, especially when you're talking about reshoring, right? That's a big change that even if it's not deglobalization, it's sort of changing of spheres of influence, or just making sure your supply chain has redundancy and isn't as stretched and vulnerable to even geopolitical events. However you want to phrase that, seems to really make sense. And then yet you see so many headlines about layoffs. Companies are just very quick and willing to lay people off. That was a big change. And there's no such thing as job security anymore. Or they'll take you from being staff to being contract, to cut costs. So it doesn't feel like there's any kind of bargaining, that workers have that much ability to be able to really push for those wages. Is that just because it feels that way and it's changing and it hasn't gotten around to everyone yet? Or is it a sort of divide on what part of the economy that you touch and that you're working in?
Yeah, I think that's a really important point. And I do think it really is, what part of the economy are you talking about? Because if you're talking about healthcare, the demand for labor in healthcare is huge. And you have to have people who are trained to do certain things. And it's difficult to source that labor right now. You look at even just, people coming out of college with accounting degrees, right? The Wall Street Journal has done several articles about this and how CPAs are really struggling to keep up with the demand for bookkeeping and tax work and stuff when there's nobody wants to get an accounting degree. And so, I think you have a lot of these areas of the economy where people, and, even just in the construction, section of the labor market, right? I've heard a lot of talk about, yes, home building has slowed down to a degree, but with all the infrastructure spending, those people might not be building houses, but they're being put to work building other things. And there's only so many of those people in the economy that are
Yeah.
equipped and, willing to do that work. And so I think in those specific areas where the labor demand is still, I mean, we talked about the demographic trend with, baby boomers aging, retiring, putting a demand on the healthcare system, a greater demand on the healthcare system at a time when those people working within the healthcare system are shrinking as a percentage of the overall population. And so
Mm.
I think those are areas, I mean, you can look at, there's a number of them where you need people that are skilled in certain areas, and we just don't have enough of them, and that creates those wage pressures that we're seeing that are kind of rippling through the economy.
Yeah, it's so interesting because whenever you're in transition, because we think about, automation and robots and what that means too, and it's hard to know. It's just hard to figure out what's happening here. So I think it leads to some of that conflicting data. My colleague Andreas dropped his latest steno signals on our platform today. Check it out if you haven't, everybody. And I think you were tweeting about that. And Andreas also warning about the risk of reacceleration of inflationary pressures, and he's focused on liquidity, and we know how important that is. Where where is this pressure? So you mentioned wages. Where else is this pressure coming from? Because Bo just asked a question, and there's some great ones. I'll get to them, guys. Jesse, I read Great Britain and Japan have fallen into recession, with China and Germany already weak. How does this affect U.S. markets? So what are you watching sort of globally that is either feeding or will help with inflation?
Well, I think one of the dynamics that people maybe don't talk enough about is the weakness in the Chinese economy, right? The Chinese economy has struggled mightily for a couple of years now, and that's been an important disinflationary force, right? That's helped us keep prices down and see prices disinflate here in the United States. If the Chinese economy begins to start to show signs of life again and take off again, and demand for commodities and all these things start to take off, that could be a real problem for the Fed. If 5.5% Fed funds rate is not going enough to bring the core PCE, their target, back down to 2% in a sustainable way, then you get the Chinese economy starting to take off again. I look at the commodities generally, commodities markets, and you see gas prices starting to go up again over the last few weeks, pretty significantly in a strong way. Oil price looks to me like it's bottoming, and could head higher. The supply and demand dynamics, demand keeps hitting record highs for oil, right? There's this narrative out there, which is why I think there's so much bearishness around the energy sector, that demand is going to be a problem. But all signs suggest demand is hitting record highs at the same time as supplies just aren't keeping pace. And so if you start to see a turnaround in the commodity sector, prices for these big important commodities start to take off again, that could exacerbate this reflation problem that could be potentially brewing.
Yeah, and Nixie, I think that was your question. XLE was up 2.75. Is this the forewarning that the market will start pricing in higher than expected inflation numbers ahead? CPI and PPI. It sounds like maybe you are watching that space, Jesse, for that.
Yeah, well before the CPI report came out, we saw break evens, across kind of, different timeframes. Break evens been rising pretty strongly, suggesting that, the markets have been expecting that inflation is probably going to head higher over the next, I mean, I'm talking specifically, I wrote a report last weekend highlighting the 2-year break even, which suggests that, it's closer to 2.5 than to 2, suggesting that the Fed is going to have a difficult time, bringing inflation back down to target. So I think you have a number of markets that have been pointing to this risk of reflation. And it's something that investors haven't been paying close enough attention to, because I do think, if you are pricing in, if you are investing based on a soft landing narrative, based on a no landing narrative, you're going back to that pre-pandemic paradigm of what worked in an era of ultra low interest rates. Well, it was tech stocks and, all these types of things that, really suffer from higher discount rates, higher growth names, and these types of things. If rates aren't going to go back down and we aren't going to see that pre-pandemic paradigm, then you're going to have to invest in a different way. And that probably points to things like energy, precious metals, and even things like, Chinese equities. I thought it was really interesting to see, Warren Buffett start to sell down, Berkshire Hathaway sell down some Apple. And the only thing that Berkshire's buying, Occidental Petroleum and Chevron, right? Stan Druckenmiller, Duquesne, what's he doing? He sold all of his Apple, Amazon. What's he buying? He's buying Barrick and Newmont Mining, gold miners. So you see, some of the smart investors, I think, smartest guys on the planet, adopting this. Okay, the next bull market is maybe not going to be focused on the same names that drove the last one.
Yeah, that's so interesting, and that's why we started out talking about, and as you pointed out in your fantastic research pieces, the sectors that are the most hated are starting to get some love from, these giants in the investment business. So, I mean, they have different decision-making calculations than we do. Certainly, they're playing with a lot more money
Absolutely.
than we have.
And they can change their mind. I mean,
Exactly.
talked about it. He can change his mind at any moment, and so who knows?
Exactly. Exactly. So we do have to be careful. But still that's really interesting. So Doug has a really great point, and I want to bring this up. And it's not weird, and it's not it's actually a really smart question that we don't ask enough. He said this may sound weird, but what's wrong with 3 to 4% inflation? It seems like in the past, industrial build out, i.e., onshoring, had inflation above 2% and was positive for the economy and the market. it can inflation run we had this sort of, we were more worried for all these years about deflation, disinflationary, tendencies. Can inflation run at 3 to 4%? Can the US economy handle something like that?
Well, I mean, I'm not an economist, so but I would just point out that uh, I think the assumption behind that is the Fed would maybe not, maybe they'll have a difficult time sustaining a 2% target, but maybe they could sustain a 3-4% target. But I think the history of inflation throughout time, through the United States, through other major economies, is that it's very difficult to target it, right? And as soon
Mhm,
as
yeah.
you raise your inflation target from 2 to 3 to 4, right? That, and I think this is why the Fed is really reluctant to even discuss this, is because it changes inflation expectations, right? And
Mhm.
if you change inflation expectations and people start saying, okay, the Fed is no longer committed to bringing it down to 2, I need to change the way I do business, the way I manage inventories, the way I purchase things, and that inflationary mindset could, on its own, create, kind of a chain reaction through the economy where you stimulate demand in a way that inflation doesn't just rise from 2 to 3, it rises from 2 to 3 to 5 to 7 to 8. And so that inflationary psychology, I think, is maybe the most important piece to think about in terms of that. And I think it's why the Fed is most reluctant to even discuss a higher inflation target.
Yeah, no, absolutely. But it's really interesting, Doug, and it's a point that we'll come back to because we're also coming out of this extraordinary period, right, where we had zero interest rates and we were more worried about a deflation. So, people have to kind of adjust to this if it is a new reality. And so we're not really sure how much of the old model transfers and how much doesn't, and some of the unintended consequences or knock-on effects of just a higher inflation, higher interest rate environment, even if it's moderately higher. So it's a really, really smart question. So what do you speaking of interest rates, do you think the bond market has a big adjustment to do here? Jesse, that we saw yields certainly come up back up a lot from where they were, the lows they hit when everybody was pricing in 7 rate cuts or 6 rate cuts. We've seen them come up and they're kind of now hovering right around, 4 and a quarter. But do you think that we have to go a lot higher? They're going to revisit something much higher in order to wrap our head around the idea that inflation may pick up again? Or how do you see the direction of yields? Where do you see them going?
I think, I've been for 9 months now or so, I've been telling my readers that the 10-year Treasury yield is the most important chart in the world, right? This is the one everybody needs to be watching because uh, it's still in an uptrend. I don't see any reason to believe that rates have topped out and are ready to go down in a way that bond bulls would really get excited about. You look at momentum. There's another chart that I've shared, which is basically just the price relative to the 40-week moving average, same thing as the 200-day moving average. And for a few years now, momentum has bottomed in a very clear range, and we've touched that range again recently, and rates turned higher again. And so as long as momentum is going to remain above that level, I think the uptrend is intact. And I think really, it's interesting to me to see some, uh, really successful, financial reporters kind of make fun of the idea that supply and demand is really important to this market. But supply and demand is maybe the most important fundamental for any market. And with treasury supplies growing so dramatically, and natural demand, has limits, right? I think where we've seen a lot of extra demand come from is from the basis trade, right? Hedge funds, borrowing via, repo to buy, bonds in massive leverage and essentially
Mhm.
arbitraging the difference between cash and futures. I can't even begin to imagine where treasury yields would be without the basis trade right now. And as long as we have that basis trade without any kind of interruption, it's going to be difficult, I think, for rates to go up rapidly. That said, with so much supply coming on market, I think it is reasonable to be concerned about where does the demand come from, and can these hedge funds soak it all up, or households going to have to buy a lot more treasuries and things like they have been through money market funds, which buy T-bills and all this kind of stuff. So I think this is maybe the most important thing to pay attention to with the federal deficit, so wide, right? We've really never seen outside of World War II a
Mm.
time when the deficit was so wide during an economic expansion. It's really unprecedented, and so the amount of debt is growing at a really rapid rate. The supply, and I think that so long as this yield, the 10-year yield uptrend remains intact from a technical standpoint, I think you have to be looking for higher highs.
Yeah, which is gonna, really worry a lot of people and put some strain on the system. And I want to talk about where you might see the worry, but we have a great question. Let me see if I can find it. Which was from one of your notes. Again, such a great point. And I think Paul picked up on this. Jesse, can you comment on some of the Mag 7 companies investing in their own customers who buy products from them and how that may be kind of influencing what's going on? You made this great point about so-called vendor financing. Can you talk to us a little bit about that?
Yeah, I think it's part of a bigger trend. I think what we're seeing, if you look at the earnings in the Mag 7 companies, I think we're seeing some late cycle trends, right? You're seeing that, what do companies do when demand starts to wane? I think in this case, they've said, okay, we're going to start layoffs, right? Because we need to
Right.
protect profit margins. But we also need to try and find ways to goose the top line. And I think that a lot of this AI narrative was driven by a slowdown in the cloud business and companies like Microsoft and Alphabet and Amazon needing to drive cloud revenue and some type of a narrative to hype something to drive cloud revenue. So we get the AI narrative and tons of spending there. But at the same time, in order to protect profits, they're also uh, extending the life of their servers, right? And these are accounting games that they're playing in order to make profits look better. And it's boosted the Mag 7 profits, I think 10 to 20 billion over the last couple of quarters. It's not insignificant. But you always see these types of accounting games late cycle. Another thing that they're doing, right, and Nvidia may be the most kind of guilty of this, is saying, okay, we need more people to buy, in order to sustain the price of these $60,000 semiconductors, we need to create demand. How do we create demand? We're going to invest whatever it is, $2 billion into this startup, and tell them we'll give you this 2 billion if you turn around and buy chips from us, spend that 2 billion on chips. Microsoft is doing this with OpenAI. We'll invest $10 billion in you if you invest it right back into our cloud business. And so I think you see a lot of this kind of vendor financing, which is a way to boost the top line and create demand that wouldn't naturally be there. And so I think you have a lot of these different dynamics, whether it's vendor financing to support demand, accounting games to to boost profits, and then layoffs, right, to try and protect profit margin. All these types of things are late cycle dynamics for the earnings in these companies. And I think it's important to kind of recognize that.
Yeah, I think that's such a great point. Such a great point. Wonderful research work there because it's not something that we pay attention for. But you're right. We've seen versions of this, right? Throughout history when we get to this point in this cycle. But it's super important because you're seeing these flashes and these revenues, and of course you think the stock's flying. So let's go back to this idea of interest rates hitting higher highs and the sort of knock on consequences from that. How are you thinking about commercial real estate here? Because, it was the big worry, the big sort of ticking time bomb, and then it kind of fell off everyone's radar. But just anecdotally, I'd say in the last few weeks, we've had a lot of people coming on our air and talking about being concerned about it, sort of still worried about, you know, the regional banks. And yes, they don't necessarily say it's systemic. Can the central bank ring fence issues with it? Yeah, probably. But the idea that it's just this slow moving train wreck that's just going to continue to cause a drag. And if you're talking about interest rates being higher, presumably that'll put even more pressure on that sector. How are you thinking about commercial real estate here?
Yeah, I think, it's not just commercial real estate, it's the entire credit cycle. I think you have so many companies, real estate focused or not, that have said, we're going to just hold out and pray for lower interest rates, for these refinancing cycles, right? And so I think, that a lot of companies and real estate ones have been hoping that we were going to see inflation come right back down to the Fed's target. Fed's going to cut interest rates, long-term rates are going to come down and say, okay, now we can refinance this debt. If, and this is what the markets, I think, are starting to wrestle with, is if inflation is coming back and that we're going to get higher for longer interest rates, which is something people haven't talked about for the last several months, then it means that there are going to be more and more problems with credit, right? We're not going to get the 10-year yield back down into the twos or something, and narrow spreads so that it's easy for these companies to refinance. I think the real estate is the most obvious of all of these problems, because real estate is so basically just focused on cap rates, right? What's the cap rate on the real estate, and you raise the cap rate, and the value of the property comes down, and that's what we've seen with a lot of these office properties selling for 30 cents, 40 cents on the dollar. And so I think, I've been looking at actually some of these banks, because the insider activity is something that I watch very carefully. So insiders buying in New York Community Bank. Columbia Banking System is one that I've been looking at, because I used to bank with Umpqua Bank, which is one of their brands up in the Northwest. And we've seen some good insider buying, but you look and you see that commercial loans, these types of commercial real estate loans, are 3 times their total equity. And so it doesn't take a lot of distress to really create a problem for these types of banks. And there's a good article in Bloomberg about this, where the regulators are really looking at those companies that I think have 3 times their equity capital in these types of commercial real estate loans, and that loan portfolio has grown 50% over the last several years through the pandemic. And those are the ones that are most at risk. I think there's about 24 of them.
Yeah.
And so I think that, what we've seen with New York Community Bank is probably the start of something, a bigger problem. And that's not, I'm not going out on a limb to say that, that more of these banks are going to, have issues. I don't think it's systemic, but I do think we're probably going to see more of these issues, especially if interest rates aren't going to come down pretty quick.
Yeah. And Jim Carson was on with us yesterday, made the point that if you remember the savings and loan crisis, it took 2 decades to mop that mess up. It takes a long time. And especially when you're not sure what these buildings are going to be. There are just some buildings that are not going to have the tenant rates that they had. And, it's a big change that we're going to need a solution to, much like the malls.
Right.
And everyone's trying to figure that out. So it's kind of this going to be this big dark cloud that hangs around for a while. So what are you thinking about? We'll end on oil, because you were talking about some of the investors buying it. Do you expect to see a rotation? Is that a sector that you like? And what do you think? Where do you think oil prices are going if that demand is there? It's just
Yeah.
that we haven't seen the price action. What do you see happening in that patch?
I think that, I mentioned the supply demand dynamic in the oil market, and to me, it looks like there's a mismatch where demand keeps hitting, record highs, and supplies just aren't keeping up. It looks to me very similar to the early 2000s, which was the start of the last major super cycle for oil prices. I think probably we're in the early innings of another long-term cycle for commodities and oil prices generally. What's amazing to me is that these things are so out of favor, even though they're generating such amazing returns. I mean, take Occidental Petroleum, for example, which is, one that Berkshire Hathaway has been buying, I don't know, 20 million shares a quarter or something. And I think that, Buffett owns 200 million shares or something now. Trades 7.5 times free cash flow. right? I mean, that's 12, 13% cash on cash return. I think it's very telling that, that's the only thing Berkshire is buying right now. It's essentially Occidental and Chevron. I think it's, probably a twofold thing. It's they're cheap stocks, right? Buffett is a famous value investor, but I think it's also a very, very important hedge for a portfolio that if you do own, I mean, they've got 50% of the portfolio in Apple and these other things. And if inflation is going to stay higher than people expect, you need to have some type of inflation hedge in the portfolio. I know he's owned silver in the past. I don't think there are any precious metal investments that he could buy with the amount of capital he needs to put to work. And so energy is kind of really the only area where he can do that. And I think that's what they're doing over there at Berkshire is making sure that let's buy some cheap stocks that have great free cash flow yield and will act as a nice inflation hedge in the years to come.
Yeah, the barbell, right? Because it's so compelling. Some of the tech is compelling, and if you have a long view, you can see why that's interesting. But are you protected enough? And it doesn't sound like what you're saying that the 60-40 is back based on the fact that we could see. So we still sounds like we're in for a rough ride with bonds.
I personally think, there are times when financial assets work really well. There are times when real assets work better. And I think what we've seen for the last, 10 plus years at least, is that financial assets were the way to go. I think this new bull market in front of us is more likely to be focused on real assets, commodities, precious metals, these types of things. Typically that's what works best when inflation does, end a disinflationary trend and go into something, something different. I think that's the environment we're in, and so it makes sense to focus on real assets.
Fantastic stuff. Jesse, so great to have you on. Fantastic insight. And thank you for sharing all your good research with us. We love it.
Always great to talk with you, Maggie. Thanks for having me back.
Thanks so much. Before we go, an exciting announcement. We are hosting a crypto gathering. Don't F this up edition. It's next week, February 22nd and 23rd. It is free. Just sign up at realvision.com/crypto gathering. We've got a lot of good guests. Here's Raul to give you a little more info.
Please don't fuck this up. When we've got such a massive opportunity in crypto, we become our own worst enemies. When the bull market truly starts, you end up losing your minds, doing all the wrong things, and end up poorer than when you started, or just not capturing it. Anyway, I'm serious about trying to help you not fuck this up. And the crypto gathering is all about that. 2 amazing, fun-filled days of learning about how to get this right. That's on February the 22nd, 23rd. And there'll be panels, Q&As, interviews. Come and join us. It's free. Register at realvision.com/crypto gathering. That's realvision.com/crypto gathering. And come and help yourself not fuck this up. I'll see you there.
Whether you're a crypto newbie, an established investor, or operating a business in Web3, tax season can be an absolute headache, but it doesn't have to be a nightmare. That's where Crypto Tax Calculator comes in. The software platform founded in 2018 by brothers Shane and Tim Burnett, crypto fanatics who were fed up with the complexity of doing their taxes. As Coinbase's official global tax partner, Crypto Tax Calculator focuses on simplifying complex transactions, supporting over 300,000 currencies across Ethereum, Arbitrum, Optimism, as well as 1,000 other integrations. It's as simple as connecting your wallet, pulling in all your transactions, and following the automated suggestions to quickly and accurately calculate your tax obligations. Finally, 2024 is a year when crypto investors can do their taxes with speed and confidence. Make taxes this year easy and affordable with Crypto Tax Calculator. Sign up at realvision.com/CTC and get a 30% discount with the code RV30 at checkout.